Okay, good morning everyone. So in today's session, we are going to do a bit of revision. So we're going to just look at the main components for the learning units and the key things students tend to get wrong or struggle with. And then we're going to do some practical questions to try and reinforce what you're supposed to know for the exam. So because of the fact that we only have 2 hours, I cannot cover everything, but while we're doing an exam prep session next week on the 25th, we will then cover the remaining bits and pieces in that session. Okay, so let's quickly run through just the key things for the respective learning units. If you've got questions, just stop me and ask me, and then I can re-explain it. Okay, so the first learning unit talks about your bank reconciliation. It is basically reconciling the balance in your bank statement to the balance in your general ledger, so in our accounting records. Now, what we have to do first is we first have to go through the bank statement and see what transactions have gone through the bank but have not been reflected in our cash book receipts or our cash book payments. So if it's on the bank statement, but it's not on our cash book receipt, we record it into our cash book receipt, similar with the cash book payments. However, if it is in our cash books, then we go and see, have it been reflected on the bank statement, and the items not showing up on the bank statement is then your reconciling items on your bank recon. And then the errors will be dependent on who made the error. If the business made the error would be recorded either in your cash book receipts or the cash book payment. So it's generally in the opposite cash book than the one you initially recorded it. If it was more than it should have been, if it was insufficient or less, then it would be in the same cash book. Okay, so let's quickly look at the steps. So these are the steps that you have to do in the exam. Now, the problem with these types of questions, there's a lot of information, so you need to practice how to do these things quickly and accurately. So what I normally do when I do a question like this is I tick as I go through the information and I start recording it where it belongs at the same time to save time. So by the time I finish the question, I have documented most of the information, and the little bits and pieces that is still outstanding, I deal with that then. That is generally based on the additional information. So as you can see, step one is compare your bank recon, your last month's bank recon with this month's bank statement. So we are checking whether outstanding checks or outstanding deposits on your previous bank recon has actually now reflected on your bank statement. The items that have not gone through on your bank statement yet, those ones you just carry over to the current period, unless it is, for example, a check that it went stale, then you cancel it, or if there was an RD check subsequently, or if there's additional information that tells you that transaction is no longer a reconciling item. Then you compare your bank column for your cash book receipt with the credits on the bank statement. And then the next step is comparing your cash book payments with the debits on your bank statement, and you circle any remaining or opening items on the bank statement, and then you go look at the additional information, whether it's an error or whether it is a different company's information. So once you've circled it, it would either be resolved by the additional information or it will end up on your bank recon. And then once you've dealt with something, just tick it off. And then whatever is remaining of the circled entries, that goes to your reconciliation. Now, this is what your bank recon looks like. Make sure you know the format. So you start off with your balance per your bank statement. Now, it's very important to note whether it's a favorable or unfavorable balance. If it's favorable, you show it as a positive in here. If it is unfavorable, you show it as a negative. Then your reconciling items is what appears on the bank statements or the cash books only. So it only appears on one or the other. Now, your less outstanding checks is checks that we've written as a company, but it's not on our bank statement as yet, and the same with the outstanding deposits. Your corrections are normally items that are reflected where the bank made a mistake on the bank statement, and we need to do the correction on the bank recon. And then once you've added all of that together, you should get to the balance per the bank account. Now that is the balance per your general ledger, your T account, and that is your opening balance plus your cash book, your total receipts from your cash books, less your total payments from your cash books, would give you the closing balance. So what they sometimes do is they give you the information to work out what the closing balance is, as opposed to giving you the amount at the end. And it's very important to note whether it's favorable or unfavorable when you do the reconciliation. Now that amount there at the end should agree to what's in your accounting records at the end of the month. Otherwise, you made a mistake with your reconciling items. Okay, this is just a reminder what an adjusting and a timing difference is if you need to explain it in the exam again. So remember, adjusting difference, there's a difference occurs when the business is not aware of a particular transaction. So that means the bank recorded it, but the business doesn't know about it. So we're going to adjust it in our accounting records. Now, examples of that is interest on your current account, bank charges, direct deposits. A timing difference is where the business have recorded it, but the bank is not aware of it. And that is, for example, outstanding checks, outstanding deposits. Okay. Now, key things I want you to remember when you do your cash book receipts, cash book payments, make sure that you know which transaction goes where. So your transactions that go into your cash book receipts are things where we receive money, or if it is a correction, we did not record a sufficient amount in the cash book receipts, or we over recorded something in the cash book payment and we corrected there. Now, if we've got a stale check, so a check that we have to cancel because it's older than 6 months, we show it on the cash book receipt side. And then the descriptions there, you need to be very specific with what your description is. So you need to tell me what the expense is, for example, whether it's a bank charge. Now, if there is a debit order, you can write the debit order, but then you need to specify, is it for bank charges, is it for insurance? As long as you indicate what type of expense or income it is, that is sufficient. And then if it is an RD check, we take it to debtors control. Okay, so that's where it would go. Okay, and this is the movement. It captures the transactions that appears in our bank statement, but not in these cash book journals. This is what we are reflecting here as a movement. Okay, some other things to remember. This is what your T account would look like. Remember, your opening balance on your general ledger account would be the same as your closing balance in the previous month's bank reconciliation. So that balance right at the end of the previous month bank recon, this is the balance you apply in here. Remember, you show your total receipts, total payments. You do not show the individual receipts and payments in this general ledger account, only the totals. So in the test, a lot of the students actually showed each and every individual transaction, and then you did not get the marks. And remember to show the folio numbers. So show whether it's cash book receipts, whether it's a cash book payment, is it a debtors journal, a general journal. You actually get marks for those in some instances. So please do not forget that. And then this closing balance should agree to what's on your bank recon. You actually get a method mark for transferring what you've calculated here to your bank recon. You get a method mark for that. Okay, now let's quickly look at the bank recon, just things you have to look at. So the first balance is your balance per your bank statement. That is what is on the bank. It is the last balance if they give you an entire statement at the end. Then your reconciling items is the movements between your cash book receipts, cash book payments, and those are items that do not reflect on your bank statement. So we've recorded it, but because of the timing difference, it has not gone through the bank. So those are generally your bank reconciling items. And then there is sometimes some errors where the bank has recorded something at the incorrect amount, debited it twice, or put an incorrect check through our account. And then just to repeat, that bank balance per bank account is what is the balance per the general ledger, your T account on the previous page. Okay, and then those two balances should be the same. Then you know you have done this reconciliation correctly. Okay, now in a test or in an exam, I know a lot of students struggle to balance this because you're stressed and you make errors and little mistakes. So all I want you to do is, if you run out of time and you do not have time to actually get that to balance exactly, make sure that this balance here at the bottom equals what you have in your general ledger account. Even though it's wrong, you see we give you a method mark for transferring the same amount. So you then only lose the one accuracy mark as opposed to the method mark for giving me the same balance. Okay, now learning unit 2 is our debtors and creditors reconciliation. This is where we are reconciling our debtors list. So each and every individual debtors balance, we create a list with that, to our debtors control. That is our general ledger account, where we account for all the debtors or all the creditors transactions. So that's the totals. So by the end of the day, if we take our debtors list, which is all the individual transactions, and we compare it to the totals, it should be exactly the same. Then we know we have accounted for everything on both lists. If there's a difference, you either did not record it in the individual transactions or you forgot to include it in your general ledger account. Okay, now let's look at what was the main thing students did wrong in the test. So the first thing is, when you do a debtors ledger for an individual debtor or creditor, on the left hand side, your dates, it needs to be in date format. So it needs to be the way the month goes. So the first, the second, the third. Do not mix them up, because your balances there at the end will be incorrect and you will lose the marks for that. So that's the first thing, is make sure that you put it in date format. Now I know because of the fact that they give you different ledgers, it is difficult to determine which date goes where. So you will have to go through the information they provide and then see which dates they have given you, and then based on that go and fill this in. The second thing is those document numbers. You need to specify what is it. Is it an invoice? Is it a credit note? Is it a receipt? Is it a bank statement? And then there's generally a document number. Now in the test, they marked it if you just gave a document number or if you just said it's an invoice, a credit note. So make sure that you give that information. Those are easy marks that a lot of you have lost. And then the folio numbers, you also get marks for the folio numbers. Do you have a question?
Yes, we get codes.
Okay, so they won't give you the codes in the test or in the exam because of the fact that we do not have that much time. So it will look similar to what it looks like here. Okay, so because of the fact that the codes is additional stuff that you have to fill in, they will probably only focus on this. So we want to know, do you know what the document is, and do you know what folio number it relates to? So those folio numbers, fill it in. If you don't fill it in, you lose half a mark for each folio that you've left out. And that means 4 or 5 marks if it's a long question, which could mean a pass or fail for some of you. So please do not forget that. And then remember, you need to look at whether are you busy with a debtor or are you busy with a creditor. Because based on that information, you would have to decide whether it increases on the debit side or on the credit side. Now, this is a debtors balance. We've also done a creditors one in class previously. So what you do is you bring your balance forward. So you show the balance in the balance column. Now the balance brought forward is normally the balance per the debtors list that they give you for the previous month. So you capture that debtors balance, and then the debit and credit columns is the movements for that month. So if it's a debtor and we give them another invoice, we increase their balance on the debit side, and we decrease their balance on the credit side. And the opposite is true for your creditors. Now, what students also do is they get confused between debtors and creditors. Now, if you're unsure, generally the number that they give you on the list will give you an indication whether it's a debtor or creditor. If it's a debtor, they will generally have a D somewhere in there, and if it's a creditor, it's generally a C. So if you're sure, just go look at the individual's account number to give you guidance as to whether you're busy with a debtor or a creditor. That's sort of a trick that you can look at. Okay, and then you need to do that balance column as well, because they normally give you a mark for getting the closing balance. Now that closing balance, you can see there at the bottom is 6,300. Should agree to what is on your individual debtors or creditors list for each and every individual debtor. So you can see here at the top, L. Simpson had to have the same balance. And you get a method mark for transferring whatever you calculated to that list, even though it might be incorrect. Okay. And then remember to show your calculations. If they ask you, for example, a debtors list like this, and you just had to do the calculations to work out the closing balance, show me the calculations, because if you missed something or miscalculated something, I can still give you about 70 or 80% of the marks if you've done the rest correctly. Whereas if you only give me a value, I can give you a 0. Okay, and that is how you have to work to actually pass the test or the exam. Okay, and that last amount, that 47, that should agree back to your general ledger account that shows the totals. If that amount and the general ledger amount does not agree, you made a mistake somewhere. Okay, so that is what you need to know. Depreciable assets, they've tested it a lot. Where they would potentially ask it, I think if they ask it in the exam, it will be a very short question. It won't be as bulky as the test. So they will either ask it as part of your disclosure, or they will ask you a basic calculation or general ledger account. So just one of the key things that students did wrong when they had to do the general journals is you all got the depreciation, which is debited, but when you do the accumulated depreciation, you need to indicate what asset it is for. Is it a vehicle? Is it machinery? Is it, what else is there? Furniture and fittings. So whatever description they give you, you need to include it in there. Otherwise, you don't get the mark for that account. Okay. Remember the steps of asset disposal. So if they ask you asset disposal, how do we actually get it out of our box? We start off with taking out the cost of the asset and moving it to the asset disposal account. So we debit the asset disposal and we credit our individual asset account. So that is the cost. Then the next step is the accumulated depreciation. But before we can do the accumulated depreciation, we need to see if there's any additional depreciation that still needs to be accounted for that specific period. So if we only sell it halfway through the year, you first account for the 6 months worth of depreciation, and then you do step 2. Okay. So then once we've got the total accumulated depreciation, so that's all the depreciation over all of the years for that asset, we then debit accumulated depreciation because it was initially a credit balance. And then we credit the asset disposal. So remember, in the asset disposal, it will be on exactly the same side as what it was in the initial general ledger account. So if you can't remember the journals, just remember it's going to be the same side as it was previously. And then you can work it back from there. Okay, so once I've done the cost, once I've done the accumulated depreciation, the next step is to show the payment. So it can either be bank, so we get physical cash. It can be debtors control, so I'm selling it to a customer. It can be a HP loan, so I am financing it. So you debit whatever form of payment you are receiving and you credit your asset disposal account. And then once you go balance it, that will determine whether you've made a profit or a loss. Now, if you want to work it out just on the side to make sure you get to the correct amount, you take the proceeds, so that is step 3, and you deduct the carrying amount, which is step 1 less step 2. Gives you the carrying amount, so it's cost less accumulated depreciation. You deduct that from the proceeds. If our proceeds was more than the carrying value, we made a profit. If it is less, we made a loss. And then you account for it based on that information. Now remember, once you've finished with the asset disposal, your debit and your credit side should be exactly the same, because that is just a temporary account that we use to work out the profit and loss. Okay, so that is how you know how to balance it, even if you don't know if it's a loss or a profit at that stage. Okay, so that's just the depreciation that I've told you guys about. Okay, note disclosure. If they ask you this again, I want you to see that the accumulated depreciation, the disposals, the depreciation, you can see they're all in brackets. They're all negative amounts. What a lot of you did is you left it as a positive. And then when we disposed of the asset, you still had a value at the end of the year. So your carrying amount still had a value where it should have been 0. And the reason it was not 0 is because of the fact that you did not show the symbols correctly. Okay, you need to show a negative, otherwise you will not get the mark. So in the test, I still gave you guys marks if you did the calculations for it, but technically you should have got a 0 for it. Okay, so do not make the same mistake in the exam. Okay, so beginning of the year, that's your opening balances. We normally pull it either from our financial statements or the information they give you. Now, if they give you the balance at the end of the year and we've made a disposal or additions, you would have to adjust the closing balance with those amounts to get to the opening balance. You need to read carefully which balance do they give you and what additional information they've given you. The main thing with this type of disclosure is show your calculations. A lot of you made mistakes with, for example, the depreciation or the disposal calcs. And because you did not show me a calculation, you got a very low score for this type of question, where you could have gotten closer to a 50% if you just showed me your calcs. Okay, so remember, show the calcs. It is very important. Okay. So your additions, your disposals, your depreciation is your movements. Now remember, your disposal is at carrying value. So when you have to do the amount at the end of the year, you have to go back to your calculation where you did the disposal to see what is the cost portion that was disposed of and what was the accumulated depreciation in order to get the correct values at the bottom. Okay. And then you do this, a column for each and every category. So if we've got land and buildings as well, we would do another column for land and buildings. And then that total balance, the net amount at the end, the carrying value, is what is disclosed on the face of your statement of financial position. We show the carrying value and not the cost and accumulated depreciation separately. Okay, statement of your sole proprietor. Now, learning unit 4, 5, 6. So your sole proprietor, your partnerships, your closed corporations. The financials look very similar. There are just specific things which changes. Now, the main thing that changes between the 3 entities is your equity accounts. Your profit and loss account will remain the same. Your statement of equity will change due to the type of equity account you have. And then your statement of financial position, your assets and your liabilities will look exactly the same. It's only the equity portion that would vary between the different entities. So for the exam, when you're studying, start with your basic statements for a sole proprietor, and then when you do the one for the closed corporation and the partnership, take that same one and just go indicate for yourself where that specific one changes. So you don't have to restudy the whole format. You only have to study an additional portion. That will make up some time for you guys so that you can focus on other things as well. And then the note disclosures is generally just giving a detailed list of all the items that is captured in a specific line item. So it's just adding all the individual amounts. So make sure the ones they like to ask is, for example, your PPE. They generally ask trade payables, trade and other receivables, and then for your CCs, it's transactions with members they will ask, and then they could potentially ask your long-term borrowings if there's an element that is short-term that's supposed to be under current liabilities. They will also ask you that one. Okay, so let's quickly discuss when we do financials. Before we can even do a financial, we have to do certain year-end adjustments. Now, the first one is your depreciation, would normally have not been accounted for. Then we look at what they call the accruals concept. So that is an income or expense. So either the income we've earned it, we've delivered goods or services, or the expense we've already received the goods or services from our creditors, but we have not paid them. So we have to record it in our accounting record to show the correct income or expense for our current year to work out the correct profit, and then show the respective asset or liability. Then our allowance for credit losses, that is where we say, okay, this portion of the debtors we expect not to receive in the future. We generally do adjustment at year end based on our debtors listing. We would update that value or decrease that value based on what is left over. So that is also adjustment that you need to be aware of. Now, the main adjustments they will ask you is prepaid expenses, accrued income, income received in advance. Make sure you know the journal entries for these. So you know what account is being debited, you know what account is being credited, and how to calculate it. Okay, so on this slide, I've indicated whether the prepaid expense, the accrued expense, will it be an asset or a liability in your books? So if it's an asset, we debit it. If it's a liability, we credit it. And then the income or expense account linked to that account will then be the opposite entry. Okay, with these transactions, also show me your calculations. Okay, because you guys do actually get marks for some of these calculations. Okay, partnerships. Now, partnerships is where there's multiple people, so two up to 20 people that runs a partnership together. Now, they've got a partnership agreement on how the profits are being split. Now, for partnerships, they did ask it in last year's exam, so you need to know the section. So the main difference with a sole proprietor is the proprietary accounts, and then the equity section looks slightly different. And then we've got additional year-end procedures. So normally with a sole proprietor, we've got a trading account and we've got a profit and loss account when we do year-end closing transfers. For a partnership and a CC, the additional account is the appropriation account. That is where we take the normal profit for the business and then start making specific payments out of the partnership, so like salaries, bonuses, and then include any interest on the current accounts or interest on drawings would also be captured in that account, and then the remaining profit then goes to your retained earnings, but it's split between the different partners. Okay, now in your textbook, they give you the accounting cycle. So the main thing just to remember is we use the appropriation account to close off the partnership accounts. Make sure you know what that appropriation account looks like and how to record it, because they could potentially ask this one because of the fact that this is what is different for a partnership specifically. Okay, now let's quickly look at, if we do disclosure, what type of equity accounts does a partnership have? So you remember I said the statement of financial position and your statement of changes in equity will look slightly different. Now how they differ is, for a partnership, Our capital account is only their capital contribution. It is nothing else, only the capital they put in initially. Your current account is where we show any changes to that original capital. So that is any additional income they get from the partnership, any profits they get, and then any payments they need to make to the partnership. Okay, so you'll see there, I've got distribution of profits, interest on capital, drawings, and current accounts. So that interest can be a positive or a negative depending on what their partner's balance looks like. Then salaries and bonuses. Now remember with the bonuses, it needs to be pro bono and the salary, so it's not out of the operating expenses. If it is out of operating expenses, you do not reflect it here. It would be reflected in the initial profits. And then your partner's share of the profits would be based on their shareholding in the partnership. And then the appropriation account is basically how we distribute the profit. So the appropriation column would show a 0 in your equity statement, and that amount would then be included in your current account as a positive. Okay, so appropriation shows all the income and expenses after the initial profits, and then it shows how we distributed that amount to the various partners. Okay, so this is just how your statement of financial position differs. So you'll see the total equity is split between your capital and your current accounts. It's the only two things you disclose in the equity. The appropriation account is not an equity account. It's a year-end account which we use to close off the profits and losses. Okay, and then your statement of changes in equity would be your capital account, current account. For each and every partner, you show their movements. And then you'll see there's an appropriation column. That is just to show how the profit and losses have been worked out that got distributed to your individual partners in their current accounts. Okay, so that's the only place where you will show the appropriation column. And this is just the second page of it. Okay, now your statement of changes in financial position, remember to study the note disclosures as well. They can ask them, make sure you know what they look like. So they can either ask you an extract of it. So for example, just say, do the long-term borrowings, but I want to see the note disclosure as well. So they can do it that way as well. So make sure you know all of the information because they can ask any of it. Okay. Closed corporations. Now, closed corporations is the old form. They have changed it now that you have to register as a PTY Limited now going forward, but you could remain as a closed corporation in the past. Now, make sure that you know the advantages and disadvantages that are listed in your textbooks if they ask you a short question on that. Now, the main advantage originally was that a closed corporation would not have to be audited. Now, that is no longer the case. It is all dependent on your PI score, whether you will have to have an audit or not. Okay, now remember for a closed corporation, we don't have equity. We have members funds and members net investment. That is the equity names. Now remember how to calculate it. Members interest is your members contribution. That's their capital they put into the business. Plus your surplus from revaluation. That is the portion that your land and buildings have increased to reflect the market value. So the difference between what you paid and the market value goes to your surplus of revaluation. And then your retained earnings is generally your profit and loss, your opening balances, and then less any amounts that was distributed out. Your members net investment is your members interest. So the first three items, and then you add loans from members. So that is money they borrowed to our CC, and loans to members is money the CC borrowed the individual members. Okay, so that's why you add the loans from members as a positive to their members' interest, and you deduct loans to members from their net investment. Make sure that you know how to calculate these. They will ask it. Okay, there's three ways which member interest can change in a CC. The first one is a member resigns. Second one is we've got a new member that joins. And the third one is an internal transfer. Now, if a member resigns, what basically happens is whatever their member's interest is in that business gets paid out. It does not affect the retained earnings of the other members. The only thing that changes is their members' interest percentage that you need to calculate. If a new member joins, the member's interest percentage changes. So whatever percentage you have, you multiply with the percentage that the other person acquired to work out the portion you sold to that person. Now, what you have to do is, in addition to that, whatever retained earnings or funds they have in the CC, that percentage is also sold to the new member and then gets deducted of your remaining members and moved to the new member. And then an internal transfer is basically where one member sells a percentage of their member's interest to another member. Now, it's important to read, are they selling 20% of their interest or is it 20% as a whole? Now, generally how they state it is they will sell you 20% of the member's interest, which means if a member has 50%, it's 20% of the 50%, which is actually 10% of the total interest that is sold. And then you do a capital and a retained earnings distribution between the two members in that scenario, just based on that percentage. The amount they physically receive, you do not do anything with that. That is a payment that happens outside of the CC. You only transfer the portion that they've acquired within the CC and you ignore that amount. Be sure to know what the statement of changes in net investment look like. You only have to do the total column. Now, why I show you the other two columns? That is how you will do your calculation to work out the amount for the total. You do not need to disclose the individual members' columns amounts unless they specifically ask for it. And we reconcile the opening balances to the closing balances. Now, what you will see, we distinguish between all of the individual items. So our members' contributions, the capital portion. Retained earnings, which relates to their profits in the CC. Then loans from or loan to members. So loans from members when a member gives a loan to the CC. Loans to a member is when the CC borrows the individual member money. And then at the bottom, you'll see there's a revaluation surplus as well. That is if we've increased any land or buildings that value, that would also be reflected in there. And then we reconcile each of those accounts by showing the movements in the middle for the year. They could also ask it, one of the questions in your textbook is where they ask you the movement to show each and every transaction. Make sure that you know just how to do that instead of the totals if they ask it potentially that way. So then instead of looking at a total movement, we look if you can do each and every transaction or different type of transaction for this type of disclosure. Then the other note that is specific for a CC in your notes disclosure is transactions with members. This is already included in your profit before tax amount, but here we just reflect what is specific payments to our members based on the CC specific. So it's generally interest received or interest paid and any salaries that are paid out, and you reflect what amount was paid to what member. Okay, other things you need to disclose for CC specific is your contributions to your members, retained earnings, revaluation of PPE, amounts of loans to members and the loans from members. So that is your statement of changes in the equity or your changes in net investment specifically for CC. Okay, last thing, incomplete records. This is where you do not have all the information. Now, there's one of two ways they can ask it. They can only ask you, for example, for the statement of financial position, where they will give you the assets and the liabilities information, and then they will give you some of the equity information so that you can work out the profit or loss for the year, or the owner's equity amount, which will then be your balancing figure. If they ask you for a statement of profit and loss, they will give you debtors and creditors information, but they will not tell you what the purchases and the sales are. And you will have to calculate those values. Do you just want to put your alarm off, please? Okay. So if they give you debtors and creditors value, but they don't give you sales and purchases, you need to do a general ledger account for your debtors control, creditors control to work out what is the sales or purchases. In incomplete records, this is the exception to the rule. That T account is not done 100% according to your accounting rules and principles, because normally the bank balances we receive includes both cash and credit sales or purchases, and you can't distinguish between the two. So that sales or purchase in that account would actually be made up of both cash and credit, and not purely credit as it should be. But it's only applicable when you deal with incomplete records. Otherwise, you need to make sure that you disclose it as they show it in Learning Unit 2. Okay, so I've discussed that. Okay, so before we move on, do you guys have any questions before I start? Okay, let's maybe take a 10-minute break, or a break till 9. And then we'll continue with the actual questions. But do you have questions for me? Guys online, do you have any questions?